So Nvidia just guided $108 billion in revenue for a single quarter, growing over 106% year over year as a $5 trillion company, and added a $250 billion in market value in just one night. But three quiet details are buried under the celebration, including who sold over $400 million of the stock the month before. Here's the full story of the biggest boom in market history and why your retirement is more exposed to it than you realize.
So, a single company just told the world it expects to make $108 billion in the next 3 months from selling one product, and the number is so large it broke the frame most people use to understand money. To put it in human terms, $108 billion over 3 months is more than $1 billion every single day, including weekends, including holidays. It is more revenue in 90 days than almost every company on earth earns across an entire year of operation. And this is not the amount Nvidia has already made. It is the amount Nvidia is promising to make next. A forecast, a guidance number, delivered with the calm confidence of a company that has beaten its own impossible predictions 9 quarters in a row. Let that settle, because the scale here has genuinely broken away from anything in financial history. In the quarter it just reported, Nvidia brought in $96.2 billion, more than double what it earned in the same 3 months a year earlier, a growth rate of 106%. Not 6%, not 16%. 106% of growth for a company already worth more than $5 trillion, making it the most valuable company that has ever existed anywhere on the face of the earth by a wide margin. Companies this size are supposed to grow slowly, like aging giants, a few percent a year if they are lucky. Nvidia is the largest company in the world, and it is growing faster than a tiny startup, which has simply never happened before at this scale. And when the numbers landed, the stock erased every recent loss and surged, adding $250 billion in market value in a single evening of after-hours trading. More value created in one night than most entire industries are worth. To grasp how far outside normal experience these numbers sit, consider that the $250 billion Nvidia added in a single evening is larger than the entire value of household names like Coca-Cola or McDonald's or Disney. In one night, on one earnings report, this company created and then held more new value than some of the most famous companies in the world are worth in total after a century of building. And the $108 billion it expects to earn in the coming quarter is larger than the annual economic output of entire nations, larger than the yearly revenue of all but a tiny handful of companies on the planet, earned in 90 days, from selling what is at heart a single category of product. When a set of numbers detaches this far from anything in ordinary experience, it becomes hard for the human mind to hold, and that difficulty is itself part of the danger, because numbers we cannot feel are numbers we cannot judge. Come for the finance, and stay for the part of this story that the euphoric headlines are burying, because underneath the record numbers and the champagne there are 3 quiet details that every person with a retirement account needs to understand, and one of them is sitting right there in the fine print that nobody is reading. This is a story about the greatest boom in the history of technology, and about who is quietly heading for the exits while the crowd is still cheering. To understand why this matters to you, first you have to understand what Nvidia actually is, because most people have heard the name without grasping why this one company has become the beating heart of the entire stock market. Nvidia makes the chips that make artificial intelligence possible. When you hear about AI, about chatbots and image generators and the enormous data centers being built across the country, all of it runs on specialized processors, and Nvidia makes the ones that everyone wants and nobody can replace, to the point where it holds something close to a monopoly on the most advanced ones. Every major technology company on Earth, the giants whose names fill your retirement account, is locked in a spending race to buy as many Nvidia chips as they possibly can, because they are all terrified of falling behind in artificial intelligence. That spending race is what turns into Nvidia's revenue. When those giants spend, Nvidia earns, and right now they are spending like nothing anyone has ever witnessed. What makes Nvidia's position so powerful is that it is not merely selling a product, it is selling the one product that has no real substitute at the frontier. When a company wants to train the most advanced artificial intelligence, it does not have a menu of competitors to choose from. For the most demanding work, it needs Nvidia, which lets Nvidia set its prices with a freedom almost no other company enjoys, and explains those extraordinary profit margins. This near monopoly is the deepest source of Nvidia's strength, and also in a quieter way, a source of its risk, because a position that dominant invites the entire world to try to unseat it. Every giant customer is now also working to design its own chips to escape its dependence. Governments are pouring money into rival efforts, and the prize for whoever cracks the monopoly is measured in trillions. For now, Nvidia's lead looks commanding. But monopolies at the peak of a boom have a way of attracting more competition than any fortress can hold forever. Here is the number that captures the mania. Nvidia's finance chief told analysts that the company expects between $3 trillion and $4 trillion to be spent on AI infrastructure by the end of this decade. $3 to $4 trillion on data centers and the chips inside them in just a few years. That is a wave of spending larger than the economies of most nations on Earth, and Nvidia sits at the center of it, collecting a toll on nearly every single dollar of it. This is why the company has become the single most important stock in the world, and why its earnings night has turned into an event that moves the entire market. Because Nvidia is no longer just a company. It has become a living proxy for the entire artificial intelligence boom, the one stock that tells the whole market whether the dream is still alive and still worth believing in. Now let me teach you the one idea you need to judge any of this for yourself, because it is the difference between a good company and a good investment, and almost nobody explains it. A stock's price is not the same as a company's quality. A wonderful company can be a terrible investment if you pay too much for it, and a mediocre company can be a fine investment if you buy it cheap. The tool investors use to measure this is the price-to-earnings ratio, and here is the plain version. It tells you how many years of a company's current profits you are paying for when you buy the stock. A boring, steady company might trade at 15 or 20 times its earnings, meaning you are paying 15 to 20 years of profit for your share. Nvidia, even after this enormous run, trades at a level that only makes sense if you believe its profits will keep exploding for years to come. You're not paying for what Nvidia earns today, you're paying for a future in which it earns vastly more, forever without stumbling. That is the bet baked into the price. If the future arrives as promised, the price is fair. If the growth slows even a little sooner than the crowd expects, the price has a very long way to fall, because it was never built on today's reality, it was built on a flawless tomorrow. Now, let me show you why Nvidia matters to you personally, even if you have never bought a single share, because this is the part people miss. Nvidia has become so enormous that it now makes up a staggering share of the entire American stock market. When a company grows to more than $5 trillion, it becomes one of the largest pieces of nearly every index fund in existence. If you have a retirement account, a 401k, an IRA, or a target date fund, and it holds a broad market index fund, which the vast majority do, then Nvidia is very likely your single largest holding, or close to it, whether you chose it or not. You own a piece of this company, your retirement rides on its stock. When Nvidia has a good night, your account quietly grows. When Nvidia stumbles, your account quietly shrinks. This one company and the AI dream it represents now carries an outsized share of the retirement savings of an entire nation on its back. And this cuts in a way that is easy to miss when the news is all celebration. On the way up, this concentration has been a gift. The extraordinary rise of this single stock has quietly lifted the retirement balances of tens of millions of people who never bought a share of it directly, padding 401k statements and making the last few years of market returns look far better than they otherwise would. Most people enjoying those gains have no idea how much of them came from this one company, but concentration is a gift that works in both directions. The same math that lifted your account so powerfully on the way up would drag it down just as powerfully on the way down, because when one stock is this large, a share of the index, its fall is the index's fall, and there is no longer a crowd of other companies large enough to cushion it. The gift and the risk are the same fact, viewed from two directions, and tonight the whole country is holding it, whether it knows it or not. And that brings us to the first of the three quiet details buried under the celebration, the one hiding in plain sight. On the very same day, the world was cheering Nvidia's record numbers. A report circulated with an uncomfortable question attached to it. Nvidia doubled its sales, and yet who sold more than $400 million of Nvidia stock? The month before, the answer is the people who know the company best. Company insiders, the executives and directors who sit inside Nvidia and see everything before the public does, had been selling large amounts of their own stock in the period leading up to these blockbuster results. Now, insider selling is not automatically sinister. Executives sell shares for all kinds of ordinary reasons: to buy houses, to diversify their wealth, to pay taxes, often on prearranged schedules set months in advance. But when the people with the clearest possible view of a company's future are trimming their holdings while the public piles in at record highs, it is worth pausing to notice. The insiders were selling into the strength, handing their shares to an ecstatic public at the top. That is a pattern that has appeared near the peak of nearly every great boom in history, and it is worth understanding regardless of which way the stock goes from here. At the same time, it is only fair to note the other side of the ledger, because Nvidia is also handing enormous sums back to its shareholders. Alongside these results, the company's board authorized an additional $60 billion to buy back its own stock, on top of billions already returned. Those buybacks are a powerful support for the share price, because the company itself becomes a giant, steady buyer of its own stock, and they signal management's confidence that the shares are worth owning. So the full picture is a mixed one. Insiders are selling their personal shares even as the company spends tens of billions buying shares back, which are two different things pointing in two different directions, and honest analysis has to hold both at once rather than seizing on whichever one fits a preferred story. The second quiet detail is stranger and more important, and almost nobody is talking about it. Nvidia is quietly becoming one of the largest investors in the world, and it is investing in its own customers. Buried in the numbers is a remarkable figure. Nvidia ended the quarter holding nearly $94 billion in equity investments in stakes in other companies, up from around $35 billion at the start of the year. In just 6 months, Nvidia poured more than $40 billion into buying stakes in other businesses. And who is it investing in? Overwhelmingly, the very companies that turn around and buy its chips. The AI startups, the cloud builders, the model makers. Nvidia gives them money and they use that money in part to buy Nvidia chips, which shows up as Nvidia revenue. Money flows out of Nvidia's left hand into a customer and comes back into Nvidia's right hand as a sale, and the same dollar can be counted as both an investment and revenue as it goes around the circle. This has a name that should make the hair on your neck stand up, because it has appeared before every major technology bust in modern history. It is called circular financing or vendor financing, and it works like this. A supplier funds its own customers so they can afford to buy the supplier's product. On the way up, it looks like explosive growth because sales keep climbing, but the growth is partly an illusion because the supplier is essentially buying its own revenue by funding the buyers. If the boom ever slows, the whole circle can run in reverse, with the funded customers unable to pay, the investments collapsing in value, and the revenue that depended on them evaporating all at once. This exact pattern helped inflate and then detonate the telecom bubble at the turn of the millennium, when equipment makers lent money to the very companies buying their equipment, booking huge sales that later vanished into bankruptcies. Nvidia's $94 billion investment pile is not proof that anything is wrong today. The company is generating enormous real cash from real customers, but it is a thread worth watching closely because circular money flows are one of the classic signatures of a boom that has started to feed on itself. The third quiet detail is about how the entire market now leans on this single company and how dangerous that has quietly become. Because Nvidia is so large, its earnings night has become a night, the whole market holds its breath. A single company now has the power to lift or sink the retirement savings of tens of millions of people in one evening, based on one earnings report. This is called concentration risk, and it means the market has become dangerously dependent on a tiny handful of enormous companies, with Nvidia at the very top. When one stock becomes this large a share of the whole, the comforting old idea that an index fund spreads your risk across hundreds of companies quietly stops being true. A huge slice of your money is riding on one company's continued flawless execution. Nvidia has delivered that flawless execution for 9 straight quarters. But the more the entire system depends on one company never stumbling, the more violent the reckoning becomes, if it ever does. There is a fourth way this reaches into your life that has nothing to do with the stock market at all, and it may be the one you feel most directly. Those enormous data centers full of Nvidia chips consume staggering amounts of electricity. A single large AI data center can draw as much power as a small city. As hundreds of them are built across the country to house all these chips, they are placing an enormous new strain on the electrical grid, and that strain shows up on the power bills of ordinary families who live nearby. In parts of the country where these data centers have clustered, residential electricity bills have climbed noticeably because the data centers compete with households for the same limited supply of power, and because utilities pass the cost of new infrastructure on to everyone. By some estimates, data centers could consume a tenth or more of all American electricity within a few years, up from a small fraction today. So the AI boom that is inflating your retirement account may also be quietly inflating your monthly electric bill. A strange and direct connection between a chip company's earnings and the cost of keeping your lights on. You're paying for the AI revolution twice, once as an investor whether you know it or not, and once as a ratepayer when the electricity bill arrives at the end of the month, larger than it used to be for reasons the utility will never fully explain. Now, let me walk you through the sheer scale of what just happened, because the growth here is so extreme it deserves to be spelled out slowly. 4 years ago, Nvidia was earning a small fraction of what it earns now. If the company delivers the $108 billion it is guiding for the coming quarter, that would represent growth of more than 1,700% in 4 years, a figure worth reading twice. Not 17%, but 1,700%, a more than 17-fold increase for a company that is already the biggest on the planet. There is simply no precedent for a company of this size growing at this speed. The great industrial giants of the past The oil empires, the railroad barons, the telecom titans all took decades to build their fortunes. Nvidia has compressed a full industrial revolution's worth of growth into roughly 2 years. When people say we are witnessing history, in this case the phrase is not hype. It is a plain description of the numbers, and there is a detail in the guidance that makes it even more staggering and reveals both the strength and the strange politics tangled up in this story. That $108 billion forecast assumes zero revenue from selling advanced data center chips to China. None at all. China is one of the largest technology markets on Earth, and ordinarily it would be an enormous source of sales for Nvidia. But a tangle of government restrictions, national security concerns, and trade tensions between the United States and China has effectively frozen Nvidia out of selling its most advanced chips there. So Nvidia is guiding to more than $1 billion a day in revenue while writing off one of the biggest markets in the world entirely. If those restrictions ever ease and China sales resume, that would be billions of dollars of additional revenue stacked on top of an already historic number. The company is posting records with one hand tied behind its back. Part of what keeps this engine running is a relentless product treadmill, and understanding it reveals both the strength and the fragility of the whole machine. Nvidia does not sell one chip and rest. It launches a more powerful generation roughly every year, each one faster than the last, forcing its customers into a perpetual upgrade race to avoid falling behind. Its current generation, built on an architecture called Blackwell, is ramping at full speed, and the next generation, called Vera Rubin, is already coming, reportedly ahead of schedule. This constant leapfrogging is a large part of why Nvidia's margins are so extraordinary. For every $100 of chips it sells, it keeps around $75 as gross profit, a margin almost unheard of for a company that makes physical hardware, and a sign of just how much pricing power its near monopoly gives it. Its chief executive captured the moment with a line that has become a rallying cry for the believers, declaring that artificial intelligence has reached an inflection point, that it is now doing useful and profitable work, and that compute itself has become revenue. That is the bull case in a single phrase. But a treadmill has a hidden danger. It only works as long as everyone keeps running. The moment the customers decide they have bought enough chips, or that last year's models are good enough, the relentless upgrade cycle that powers Nvidia's growth could slow abruptly, and a company priced for perpetual acceleration does not react gently to a slowdown. Now step back and look at the whole picture, because this is where the story becomes genuinely important for your financial life, beyond the spectacle. What we are watching is the largest concentration of capital and expectation in the history of markets, all flowing toward a single theme, artificial intelligence, and largely through a single company. This is thrilling on the way up, and your retirement account has almost certainly grown because of it. But history teaches a hard lesson about moments exactly like this one, and it is worth hearing clearly, even in the middle of the euphoria. This is the single most important question in the entire economy right now. So let me make it concrete. The technology giants are on track to spend something on the order of hundreds of billions of dollars a year, heading toward trillions, buying Nvidia chips and building data centers. For that spending to make sense, artificial intelligence has to eventually generate returns large enough to justify it through new products, higher productivity, and real profit. And here's the uncomfortable gap at the heart of the boom. The spending is happening now at colossal scale, while the profits from AI are still relatively modest and unproven by comparison. The companies are building the factories of the future on faith that the demand will arrive to fill them. If that faith is rewarded, this will be remembered as the greatest investment in history. If the revenue arrives far slower or far smaller than the spending assumed, then a great deal of that investment will have been premature, and the correction will be severe. Nvidia sits at the exact center of this bet because it collects its money the moment the chips are bought, long before anyone knows whether the AI those chips power will pay for itself. Nvidia gets paid on the promise while everyone else is betting on the delivery. And this is why some analysts describe Nvidia as the one company that wins no matter what happens in the short term. Because whether the AI boom proves wise or reckless, Nvidia collects its money as the chips are sold either way. The risk it carries is not this quarter or next. The risk is what happens if its customers, the ones spending those trillions, ever collectively conclude they have overbuilt and slam their spending shut at the same time. That is the scenario that would finally reach the one company that has seemed untouchable. And it is the reason even a report this triumphant deserves to be read with one eye on the history of every boom that came before it. Let me place this in historical context, because the pattern of a revolutionary technology driving a handful of companies to spectacular heights, and then testing the investors who arrived late, is one of the most repeated stories in all of finance. Go back to the year 2000 at the height of the dot-com boom. The company at the center of it then was a maker of networking equipment, the picks and shovels of the internet gold rush, much as Nvidia is the picks and shovels of the AI gold rush today. That company briefly became the most valuable in the world, its revenue soaring as everyone raced to build the internet. The story was true, and the internet did change everything. And yet that company's stock at its peak has still not returned to those heights a quarter century later, because the price had run so far ahead of even a wildly successful reality that no future could justify it. The technology won, but many of the investors who bought at the top did not, and that is the essential lesson. A technology can be genuinely revolutionary, and the leading company can be genuinely dominant, and the stock can still fall for years if the price has outrun what even spectacular growth can deliver. Consider also the telecom boom of that same era, the one I mentioned earlier with the circular financing. Companies laid enormous amounts of fiber optic cable across the world, funded in part by equipment makers lending money to their own customers in a frenzy of building for a future everyone was certain would arrive. The future did arrive in full, and we use that fiber every day now. But the companies that built it mostly went bankrupt, because they had built and spent and borrowed far faster than the actual demand materialized. And when the gap between the spending and the reality became clear, the whole structure collapsed. The infrastructure survived and served the world, while the investors were wiped out. The echo of that story in Nvidia's customer financing and the trillions being spent on data centers is worth holding in your mind. Reach back further to the great booms of the deeper past, from the railroad manias of the 1800s to the electrification boom of the early 20th century. Each time, a genuinely transformative technology arrived. A frenzy of investment followed, a handful of companies soared to breathtaking heights, and then a painful shakeout separated the technologies that endured, which was most of them from the investors who had paid too much at the peak, who were often ruined. The technology almost always delivered on its promise eventually. The timing and the price were what destroyed people. Artificial intelligence may well be the biggest of all of these, a genuine revolution that reshapes the world. That can be completely true at the same time that today's prices turn out to be too high for the investors buying at this exact moment. There is one historical parallel so precise, it is worth telling in full from the boom of the 1920s. In that era, the revolutionary new technology was radio, and the company at the center of it was the Radio Corporation of America, known as RCA. Radio was going to change everything, and it did, connecting the country and creating entire new industries. RCA was the glamour stock of the age, the one everyone had to own, and its price soared to dizzying heights as ordinary people poured their savings in, convinced they were buying a piece of the future. They were right about the future. Radio transformed the world completely, and yet RCA's stock at its 1929 peak then collapsed by more than 95% in the crash and depression that followed, and it took decades to recover. The people who bought the most exciting technology stock of their generation at the peak of the most exciting technological revolution of their generation were financially devastated, even though they had been completely right that the technology would change the world. The lesson could not be more relevant tonight. Being right about the revolution and being right about the stock price are two entirely different things, and confusing them has ruined more investors than almost any other mistake in the history of markets. Now follow the money to see clearly who stands where in this vast drama. On the winning side so far are the early investors who bought Nvidia years ago and have ridden it to fortunes, the company's founders and longtime employees, and the funds that positioned early. The insiders selling now are quietly locking in some of those gains. Some of the most storied investors in the world have looked at this exact picture and stepped to the other side of it, placing bets that the AI boom is running too hot. A famous investor who foresaw the 2008 housing collapse has publicly warned that the current AI enthusiasm carries the hallmarks of a bubble and has positioned against parts of it. Betting against a boom this powerful has been painful, because the boom has kept climbing and punished the doubters again and again, which is itself one of the classic features of a late-stage mania, where the skeptics are humiliated right up until the moment they are proven right. The point is not that the skeptics are correct and the believers are wrong. The point is that some of the most careful, contrarian, historically minded investors alive are looking at Nvidia's numbers and seeing not just a triumph, but a warning, and their caution deserves a hearing amid the deafening cheers. On the other side stands the enormous crowd of ordinary investors arriving now, near the top, buying at record highs through their retirement accounts, automatically, every payday, mostly without even knowing how much of their money now rides on this one company. And in the middle sit the other technology giants, spending trillions in an arms race none of them can afford to lose, feeding Nvidia's revenue with every purchase. The question that decides everyone's fate is whether all that spending eventually produces enough real profit to justify itself, or whether it turns out to be the largest overbuilding in history. Two scenarios frame what happens from here, and the gap between them is worth trillions. In the first, the AI revolution delivers on its enormous promise. The spending turns into real productivity, real profit, real transformation of the economy, and Nvidia's staggering growth turns out to be justified, even conservative. The companies buying its chips make fortunes using them, the circular flows resolve into genuine value, and the boom matures into a durable new era. In this world, today's prices, however dizzying, turn out to have been reasonable, and the crowd buying now is rewarded. In the second scenario, the spending race is too far ahead of the actual returns. The giants pouring trillions into AI infrastructure begin to ask when the profits will justify the cost, and some of them slow down. The circular financing that inflated the boom starts to reverse. Nvidia's impossible growth rate slows, and because the entire market and so many retirement accounts are concentrated in this one stock and this one theme, the reckoning is sharp and wide. The technology still succeeds in the long run, exactly as the internet did, but the investors who bought at the peak endure years of pain first. The insiders who sold at the top look prescient. The crowd that arrived last pays the tuition. Nobody knows which of these unfolds, and anyone who tells you they know for certain is selling something. What we know for certain is this: a single company just guided to more than $1 billion of revenue a day, growing faster than any giant in history, while its own insiders sold hundreds of millions of dollars of stock, while it quietly invested tens of billions into its own customers, and while the retirement savings of an entire nation became dangerously concentrated in its shares. All of that is true at once. The boom is real, the growth is real, the dominance is real, and so are the quiet warning signs flashing underneath the celebration. Consider for a moment how strange it is that a single company's quarterly report has become a national event, watched like a championship game capable of moving the savings of the entire country in an evening. That strangeness is itself the story. It tells you how far the market has tilted onto the shoulders of one company, how much collective hope has been loaded onto one name, and how a single set of numbers from one boardroom in California can now ripple through the financial lives of people who have never heard the chief executive's name. There has never been a moment quite like this, where so much of a nation's wealth and expectation rode on one company's ability to keep exceeding the impossible. That is thrilling to witness, and it is also, by any honest reading of history, precarious if you want to follow this story with clear eyes rather than getting swept up in the noise. There are a few concrete signals worth watching in the months ahead. The first is whether the giant technology companies keep raising their spending on AI infrastructure or begin to pull it back, because their spending is Nvidia's revenue, and the first sign of a slowdown will appear in their budgets before it appears in Nvidia's results. The second is the growth rate itself, not whether Nvidia grows, but whether the pace of growth starts to decelerate, because a company priced for acceleration reacts violently to any deceleration. The third is the health of the customers Nvidia has been funding, because if those circular money flows start to wobble, it would be an early crack in the foundation. And the fourth is the concentration of the market itself, how much of the whole index rides on this single stock, because the more concentrated it becomes, the more fragile the entire structure grows. Those four signals are the dashboard. Tonight's fireworks are the spectacle, and it is worth learning to watch the dashboard rather than the fireworks. There is an old line in markets that fits this moment better than any statistic. The time of maximum optimism is often the time of maximum opportunity. Right now, around Nvidia and artificial intelligence, we are living through something very close to maximum optimism, a euphoria unlike anything in living memory, with a single company hailed as the engine of a new age, and its stock adding $250 billion in value in a single night. That optimism may prove entirely justified. But history whispers a warning at moments exactly like this, and the whisper is not that the technology will fail, because it probably will not. The whisper is that the crowd tends to arrive at the party precisely when the smart money is quietly calling for its coat. This, as always, is not financial advice. But please understand that when a single company becomes the largest in the world, grows faster than any giant before it, and comes to sit at the center of nearly every retirement account in the country, you are more exposed to its fate than you may realize. Please understand that the same insiders who know this company best were selling into the record, that the company has been funding its own customers in a way that echoes past booms, and that the market has never been this dependent on one name. Please understand that artificial intelligence may indeed be the greatest technological revolution of our lifetimes, and that this fact and the risk of paying too much for it at the peak can both be true at the same time. The numbers Nvidia just posted are historic, genuinely, undeniably historic. History is exactly the thing worth studying right now, because it has seen revolutions arrive before, and it remembers who got rich, who got ruined, and how rarely those turned out to be the same people. Nvidia may keep defying every limit quarter after quarter and reward everyone who believed. Or the greatest boom in the history of technology may end the way the greatest booms usually do, with the revolution succeeding and the latecomers paying for the lesson. The one thing you should not do is confuse the certainty of the technology with the safety of the price, because tonight, the whole country is making exactly that bet, most of it without ever deciding to.